Hi, so I just want to do a quick video explaining how I've backtested the Trendmaster trading system that Ichimoku Scholar has developed and made freely available on TradingView. So just for anyone that doesn't know, Ichimoku Scholar created this indicator, which you can see in place here. It works with Heiken Ashi candles, and it colors the candles black or white depending on whether it's a buy signal or a sell signal. So white, is trending upwards, and if you get a white close, white candle body close above the grey, then you enter a trade with a stop on the upper edge of the range. And similarly on the short side, if you wish, if you get a black close below the grey, then you open a stop at the range there. Anyway, you can read about how it works on this tweet thread that I'll link to in the show notes. And when I first tested it, I just followed the basic premise here, and I didn't have a lot of the stop process for it is once you've entered like a long trade, once you get a black below the grey, then you can put a stop on the body of the candle, so that would stop out here. And that's the first time I tested it. I just did that. I had no other stop losses involved. And then of course he's like, well, there's other things you do. And he explained in this thread there's 3 different approaches. To the conservative, which is you keep moving the stop loss up to the body of each candle. As each candle closes, you put a stop loss at the bottom of the body. There's the moderate, which you put a stop loss on the range below each candle that it shows you. And then there's the liberal, which you move the stop loss from, so just below the opening candle, the candle that puts you into the trade, and then you only move it up on each of these fractal carrots. So each time one of these develops, you move the stop loss to that, move it to that, and then when the price moves down and hits it, then you're out of the trade. So your profit here would be from the entry up to this stop loss. So they're the 3 stop guides that Ichimoku Scholar has given me. This explains how to enter and the ultimate close signal. And that's really all I had to work with. So then what I did is I went through, I intentionally chose Ethereum Classic because it has been, particularly over the past few months, it's been the most sideways. And I wanted to test a sideways moving one because this Trendmaster, the purpose of this trading system is to identify longer term trends and get on the right side of it and let it run. So I wanted to test it in the harshest environment possible, because just my luck, if I start trading something with a great system that works in an average to ideal environment, I'll get the worst environment possible. So how does it work in the worst scenario? And I started, and he says in the first one even that this is really for longing on a weekly time frame. He hasn't tested smaller time frames so much, so he's doing that now. So of course, starting with a weekly is the best. And on my first iteration of the liberal stops, moderate stops, and conservative stops, just correct that. I was getting returns of 300%, 500%, almost 600%, 800% of my initial investment. And that's just putting $10,000 in the first trade, making a huge return, putting all of that into the next trade, making a huge return, all into the next trade, making a small loss, and so forth. So that was very promising. And then I carried on and I did it with the daily time frame, and I got similarly strong results, except for the conservative on the daily was actually a loss. Yeah, it was a loss, even without changing the thing. So what I realized anyway was that the very promising results only worked if we had these bull runs included. So if you look at Ethereum Classic, there was this ridiculously large move from $1.50 to $20. And so testing the system, it's going to identify that, and you're going to make a lot of money. If you don't have this though, And that's why I started doing this, where I'm like, okay, then let's assume I didn't get that trade. Okay, that happened, and I got all excited, and now I jump in. So my first trade is here. Now it's actually just trading at a small loss. So that's, looking at that, that is starting from here somewhere, and then only trading on the weekly time frame. There's only 3 trades identified using the conservative, moderate, and liberals use the stops. So there should be the same number of trades, really. There's a different trade there because it didn't stop before the current time frame. So anyway, that's how I got the results. Now I'll show you exactly what I've done on the chart. I'll do it on the daily. So how it works, we've got a black, the body closes below the grey, so what we do is you put a stop sell order here. The next week the candle closes like this. This is a black below the grey, and the range is here, so move the stop order to here. Move the stop order to here. And so now we've got a stop order, sell order here, and then during the next week the price moves through that, so it's hit our stop sell. So now we've entered a short position. So this is all 3 of these are like signal candles, but this is the one that ends up being used. This hits it, so we've now entered the trade, and we set a stop loss to I'm going to say the range below the candle. You could choose to set it to the candle body itself, but I like to give it a bit of room to move because it's annoying. So in this case, if you set it to the candle, it'll get hit 2 weeks later by this candle, locking in your loss. So you want to give it a bit of room to breathe, to not get stopped out too quickly in case you are on the right side of the trade. And then this is where the question is of conservative, liberal, or moderate stop losses comes in, because as the next week happens, do you then move the stop loss up to the range? Do you move it up to the candle body? Or do you wait for this fractal, which is the liberal? So it's like the next week we get this fractal. Well, actually it happens after this week, you get that. And then you move it up to, well, again, the range or the candle there. So these are the 3 generic decisions you need to make for the stops. So either way, this trade would have been a loser. Let's say we do the moderate. No, we'll leave it with the liberal. So like this happens, the stop loss stays at the range of the entry candle. Nothing happens, nothing happens, nothing happens. We get that caret indicating the fractal, so we move it to the range there. Nothing happens, nothing happens. This candle moves through it, hits the stop, therefore buys back in, and we've been stopped out of the trade. Locking in, I'll move this to there. That's the candle that stops it. We have no profit. Locking in a loss of 7.52%. And that's how I generated all these numbers. So on the daily, more different numbers from what I got there. I guess that's mostly just small variations in my placement of, yeah. It should be that different though. Anyway, so it would be minus 7.52% based on that. And now here we have a white above the grey, which puts it, we put a stop buy order here. Obviously it doesn't get hit, we move it down to here, move it down to there, move it down to here, and then it goes into the grey, or maybe we move it to there depending, but either way it doesn't get hit at any point. We're now in the grey, so we just, so this is one of the first questions. I'm not sure what's best to do here. Do we leave the buy stop order there, because until we get a black, there's no blacks come, therefore we just leave it there the whole time? Now in this instance it doesn't matter, but that's one of the questions I'm not sure about the right answer to. Generally, I think if it goes into the grey for a couple of candles, I'd probably remove the stop buy order and just wait for it to re-signal, which it does maybe this candle. If not, then definitely this candle. And same here, it's like, do you leave the stop order there once it goes into the grey? I'm not sure the right answer to that. That's one of the variables to play with the testing. But let's say we do, so we have like a stop. So I wouldn't even, I don't know why I've done this one here. That's in the grey, so I wouldn't move it down to that. But if we leave it on this one, so we have a stop buy order there, nothing happens, and then it gets hit on this candle just, but it would probably hit it. Now you're in the trade, your stop loss is down here, and then on, does depend. If you go with the moderate or conservative stop loss, you would be moving it up through this to here for the moderate or here for the conservative. And so when it shot down here, you would be stopped out on this candle at roughly 1% profit on the conservative model, or break even basically on the liberal model, on the the moderate model. One of the changes that I decided to implement was, as soon as we get a candle that closes above the break even, I would move the stop loss to break even. So that's a fourth variant of how to play with your stop losses, is I'd leave it like as very liberal until we get a candle that closes break even, then I'd move it up to that, and then I'd continue playing the liberal sort of strategy, so very loose, waiting for these carrots to indicate that we can move it to them. But in this case, it doesn't really help much anyway. Only that if you're playing the full liberal stop system, in this case, your first stop, because your entry is on this candle, your first stop would be there, and then you wouldn't change it until that's the first fractal signal, so you wouldn't change your stop loss until that, but by then obviously it's too late, you've been stopped in this candle, so you'd be locking in a loss of 3.34%. So that, and so I just went through and just did that over and over and over again until I got all the various positions. Now this move here, this is the one that makes it. Now showing you thinking behind this one, just go right in. Close that. What have we got? Let's get rid of that. So can you see that does close just above the grey? So this gives us a signal to buy. We put a stop buy order there, and the next week when it moves through that stop order, it buys into the position. Our stop loss will be starting off down here. Now with a conservative stop loss model, we'd be moving it up to here, to here, to here, and we'd be stopped out by this candle. So we would only make about 16% on that move. On the moderate, we'd get a slightly worse result, but on the liberal approach, we would move up, we'd move down, and then we'd move our stop loss to this area here, and we'd still be in the position. So my modified approach, what I would have done, and what this is modeling right now, is it starts down here, and then as soon as we get this candle closing above our break even, I'd move the stop loss up to here, which manages to just survive the red dip. So put a stop loss on the bottom of that candle. It's just below it, like you can see it's. So anyway, whatever, that would lock in, yay, I'm profitable, and awesome, I've managed to avoid being stopped out. In this instance, that doesn't tell you what's going to happen next time you trade, but that's one approach anyway, was trying to lock in the profits as quickly as possible without cutting short the profitable runs. Because as you can see on the rest of this run, it's still in the trade, he goes all the way up, he comes down again, but our stop loss is down here, down there. But now we can move our stop loss up to there. We're going up, we go up, comes down, still hasn't hit our stop loss, but we've got a new signal as of this candle, so we move it up to here. Ditto, it goes up, come down, we move it up to there. Again, move it to there. Still none of the candles touch it. Goes up again, comes down, still hasn't touched our stop loss. We set a new stop loss here. Move it up to there. Now this one, what did I do then? Hit the down arrow for some reason. I think that scrolls through all the favorite coins or whatever. Now this one, yep, it's just above it. Depending on how accurately you set it off this range, but if you're lucky in this instance and you set it just low enough and this candle didn't touch it, you're still in the trade. And that's lucky because it goes up again. And now we've moved the stop loss up to there, and then off this one. So it doesn't get hit at any point, and then we set it off this one, the price moves along. Actually, doesn't get hit until we get this one setting it, so we actually move it up to that slightly, and then finally it hits this candle, and boom, we're out of the trade. And so that is the mother of all trades, 921%. If you could have got in on that, yes, you'd be very, very happy. Now, the problem is you don't know when this sort of run's ever going to happen again. If you knew that, then hallelujah. And 27, this is the Black Swan event. This is what got half of the world interested in crypto, and not that many interested yet. Hopefully we're going to see it again. Hopefully that was just the most recent bull run, and there's at least one that will put this to shame. But there's no way that I am trading on the back of that expectation or that hope. I have to assume, as a conservative trader, that this is the norm, and so that's why going through all these testing, as long as I left that bull run in it, then I was getting amazing results. 500%. This one, 347% on the daily with liberal stops. 138% is less impressive, but still, not bad returns. So that's really just 38% gain. But if it's dependent on having a run like that in it, then it's not reliable. So that's why I went, okay, then these two trades were from that bull run. So if we start after the bull run, what our results like, and the returns without a bull run, so trading at the worst time possible, and possibly one of the worst coins to trade this strategy with, are quite less impressive. Even on the weekly time frame, even on the weekly time frame, it's just below break even. It's a loss, and obviously a loss. It's like minus 23, minus 25. If we take out that, so it's definitely a loss. That was basically the conclusion I reached. So no, having done all that, having worked through all the things, and systematically working through all these little trades, where I'm like, it's so frustrating watching a setup play out and going, oh, this isn't going to make money, but I'm going through the backtesting. The whole point of backtesting in a system like this is to be rigorous with a strict set of rules. In the real world, yeah, you want to be looking at other indicators to validate the theory, but in order for it to work, you still want to know that the strict set of rules at the core of it are able to be applied consistently and will return consistent results. And so from this testing, what I've concluded is that within anything other than a really strong bull run or really strong bear run, this trading system will generally give you losing trades. And the losses, in order to make good money with it, you want to have liberal stops. You don't want to be stopped out of a trend, because trends, as you can see in this, trends have like some really big downward movements in them. So you don't want to be stopped out of that. So you want to have really liberal stops. But of course, if you have liberal stops, then the majority of losing trades that you have will be larger losing trades, and so you're just biding your time until you get the winning trade. But the conclusion I reached was that, okay, then the problem with my approach that I'm doing here is that I'm trying to do longs and shorts, and I'm just applying them everywhere, and I'm trying them on the day scale in this particular instance. But even on the weekly scale, it wasn't profitable unless you got the bull run, which led me to the realization that the original description by Ichimoku Scholar is basically right. You use this strategy on the weekly time frame with longs. And the reason that matters is because it's not that longs or shorts win more or less, although of course they have. Longs have won more in this market because we've been in a bull market all of 2017, and with ETC it hasn't had a strong bear run. It's been pretty flat. But there's another key thing here is, as you can see in this trade, this made us 921%. Now let's imagine that from here it just went straight back down to that level. What's the short trade going to make you? Minus 90%. You get a 90% return on investment for the same movement in the opposite direction. So even if you get a strong bear movement and you trade it just as well as you trade the long movement, you don't make nearly as much money. It's just a function of, if you buy 1,000 Ethereum at $1, Ethereum Classic at $1, and it goes up to $20, you've now got $20,000. That's obvious, but I'm just $1,000 is 20,000. Which makes 1,000% return. Doesn't matter, but if you're $20,000, which is still okay. 1,000%. Why am I getting the percentages wrong in my head there? $1.45 to $15. Okay, that's right, because I'm saying $20, but this stops out at about $15 and goes up to size 25. That range there is $10, and the rest of this, because logarithmic graphs. Okay. But if you sell 1,000 Ethereum Classic at $15, and then it goes down to $1.50, you still only sold $1,000 worth. So you can't sell them for minus $1,000 is the reason why that happens. Whatever. Point is that the short trades will never be as profitable as the long trades can be. The upside to a long trade is basically infinite, and the upside to a short trade is zero, down to $0. So the conclusion I've reached is that I might keep experimenting with this to see if I can find it working on other time frames and other ways, but I suspect that it's really only useful when applied to long trades on the long time scale. So actually, the next thing I want to do with it is apply it to something like gold over the really long term. See what happens there. This is way longer than I thought. Sorry if I rambled too much, but that's all of my discoveries and what I've come up with. So thanks for watching. Bye.